As an experienced insurance agent, one of the most common questions I hear is, do I have to repay the loan I took from my life insurance policy? My answer often surprises people. No, you don't. But before you think it's free money, there's an important reason why this works and how it affects your policy in the long run. In this video, I'll break it down in simple terms so you know exactly what happens when you borrow from your policy. You don't have to immediately repay a policy loan, because when you borrow from a permanent life insurance policy, you're borrowing against the policy's own cash value. The insurance company treats the cash value as collateral and records a loan balance that accrues interest. If you never repay it, the company simply subtracts the outstanding loan plus interest from the policy's cash value, or from the death benefit when the policy pays out. Here is how it works. With most whole life or universal life policies, you build a cash value over time as you pay premiums. The insurer lets you borrow some of that cash value, usually with no credit check, because the loan is secured by the policy. The insurer pays you the loan amount in cash, and at the same time records a loan balance on the policy. That balance accrues interest. The policy contract says what rate and whether it compounds. You can repay the loan while you're alive, but the contract typically does not require repayment during your lifetime. Instead, if you die with the loan outstanding, the insurer reduces the death benefit by the loan balance plus accrued interest. If the loan balance ever becomes large enough to equal or exceed the cash value, the policy can lapse, which can create other consequences such as loss of coverage and possible tax consequences. Let's take a look at an example. Assume the current cash value of the policy is $100,000 with death benefit of $300,000. If you borrow $50,000 today, the interest on the loan is 5% per year, compounded annually. You die 3 years later and make no repayments. The loan balance after 1 year is $50,000 times 1.05, which is $52,500. The loan balance after 2 years is $52,500 times 1.05, which is $55,125. Similarly, the loan balance after 3 years is $55,125 times 1.05, which is $57,881.25. The insurer pays your beneficiaries $300,000 minus $57,881.25 equals $242,118.75. So you didn't personally write a check to repay the $50,000 loan. The insurer settles it by reducing what they would otherwise pay, but you still effectively owe it, and it reduced the policy's value. How can it work in long term? As long as the cash value growth rate, say 6.5%, is higher than the loan interest rate 5%, the growth can help offset what you're borrowing. That means the net effect on the policy value is smaller, and the death benefit stays more intact. But if loan interest outpaces growth, or you borrow too much too quickly, the policy could lapse, then you lose coverage and could owe taxes. With the right strategy, your policy's cash value can become far more than just a safety net. It can be a powerful, tax-free financial resource. Whether it's helping with a house down payment, funding a child's education, or creating a steady income stream for life, proper planning and disciplined execution can turn your life insurance into a flexible tool that supports your biggest goals at every stage of life. Don't forget to like and subscribe, so you don't miss out on more tips to grow your wealth. Let's make your money work for you.